All right, ladies and gentlemen, we're back with part 3 of the Bollinger Band video for Thinkorswim. And what we're looking at right now still here is Apple with the Bollinger Bands on our chart that we set up in part 1 of the video. And in part 2 of the video, we took a look at doing some call options on Apple starting over here. I believe it was back on November 3rd. Again, we were utilizing the Think Back tool and the Analyze tab on Thinkorswim. We set up doing pretty much a at the money option on Apple with a expiration that was pretty much 3 months out from November 3rd and 6 months out from November 3rd of 2020. And so where we left off was pretty much showing the profits that we were at based off of the date of December 15th, 2020. So we pretty much started over here, pretty much getting up off the bands and also off the support line of the trend lines that I drew in. And we ended over here in the 15, where am I at? Right here. All right. So if you haven't looked at that video, part 2, where we did those call options to see what those profits were looking like on the think back, that gives you the price at the end of the day, then take a look at that video. But I wanted to make a video, hopefully this one is shorter, of us doing a put option now. And doing a put based off of Apple reaching the bands here, right? So we're just going to look at obviously what we can see everything that happened in Apple so far. So let's just go ahead. In the past video, we saw the call option. So let's consider, say, if we wanted to enter in a put. And as we talked about in part 1, like when a stock is riding along the upside of the Bollinger Bands, we can get a good idea that it's time or some anticipation for a pullback, because it's on the top side of the bands that we want to see it, and it should pull back within the bands at least to the mean, which is our 20 simple moving average, or down to the bottom side of the band. And we kind of saw that here in October, where it pulled back down into the bands. And then of course, we saw this number here do this close to it, pull back, sideways move, then down to the bottom where we pretty much did our entry back here, and then move to the upside. Then it did the sideways move a little down to the mean, popped up where we exited in part 2 of the video. And then now we're here where it's riding, and then it does a little small dip down to the average, and then it makes its way back up to really be riding the top side of the Bollinger Bands. So at this point in time, we're at December 28th, December 29th, and we see that Apple is riding heavily that top side of the band, right? For 1, 2, 3, 4, 5 days in a row at least. So in utilizing the bands to say, hey, maybe this should be a good time to exit. I mean, not just exit, but also maybe I want to do a put play because it's riding the outside of the bands. At least maybe I can play it from the band price at this day was 135, 136, down to at least the mean, which is 128, right? Writing it down to 128.27 to the 20-period simple moving average. And as you can see, back in September, we got that same thing. I'll pull back some as it was riding the top side of the bands, and then it pulled back. Not only did it go to the mean, to the average, but it pulled back pretty much close to the bands, and then sideways movement, and kind of went all the way down. So in looking at it here, we're already in uptrend plays according to our think back, and you can see the profit on those 10 contracts we did. Watch part 2 of the video. But if we're here now, as I mentioned in part 2, we most likely would have exited our February play, because you only want to be in about a month to a month and a half, and since it's a 3 months expiration. So we exited out of this one already. So let's close that one. You pretty much made 100% profit. You either exited or set a trailing stop. And now we can still let the April one ride. It's making good money. We still have time to exit, where we would most likely exit around February. But we can also hedge against our play by doing a put, seeing that it's running outside of the bands. And when you're doing a put play, in this case, you don't necessarily, in my opinion, there's others, who would give opinion differently. But in my opinion, you could do a put play that's 3 months out because it's not going to take long for something to break down. As the saying goes, stocks or equities take the elevator up and then, take the stairs up and the elevator down. When things fall, they fall quickly, okay? But of course, it takes a lot more energy, like an airplane, to go up as you're taking off. But then if that airplane wanted to fall because the engines weren't working, that thing will drop pretty darn fast. And you can see that we kind of got this dip or fall here at the end of December going into 2021. And again, look, you have higher highs that are being created, higher lows, higher highs, a higher low, and then a higher high again. And this time we reach another, this is a horizontal resistance at this point. So this horizontal resistance is a pretty good signal that, you know what, there may be some pullback. We created higher highs to get back there, but this is where we stopped out last time, and this was right around the split. So there could be a good potential for a pullback, and 2 reasons. It's running outside the bands, and we're at a resistance level from the past. So if we're going to go into to the Think Back tool, let's go to December 29th. And if you were to see this, and you say, you know what, I think we're going to pull back because we're running outside of the bands, December 29th. Let's go to the options chain on December 29th. Bam. Let's give it some time to pull up. And we see what we got here. Ooh, give me some more space here, please. Oh, you're not going to give me space while I'm talking to people right now? So messed up. There you go. And as I mentioned, in my opinion, if you're going to do a put, you would want to do something 2 to 3 months out. So we have 2 options here. And this is obviously very interesting of what you're going to see or what you'll experience. It's like, well, I'm now going to be picking a put at the same expiration, if you did 2 months, as the one I just did the call on. Yes, you will be. That is the potential that can happen. And since you're doing a put, it's an entire different strategy of a trade, then this is suitable because you don't really need to be in a long-term put. You need to be in short-term puts, especially when you're swing trading. And the short-term could be 2, 3 months. So let's go ahead and pick the 2 month, right? So we'll pick the February one. And with this example, not picking around on how we're going to pick the strike option, let's just go ahead and pick something that's at the money as well. So we're going to do the 135 because on this particular day of 12/29, the stock was at 134, right? Yeah, it closed at 134. 87. So with the Analyze Think Back tool, let's pick the 135. So we're at the money, in the money, right? Pretty much right there. So let's go ahead and add that down here. And I'm going to pull her up a little bit. And again, you just made $10,000. So let's go ahead and buy another 10 contracts. So let's think big. And the mean or the mid price on that day for that 135 put that we're buying with the not the 130 strike. Come on, dude. The 135 strike. Thank you. So this one, 10. All right. So this one we're paying $7.87 per contract. So in this case, this is $7,875 that we're putting in. Now, also notice, since I jumped to the future on December 29th, we are still in our call from part 2 video for the April expiration strike, and it has gone to $16,000. So now you're well up over 100% on this particular trade that you're still in, and you still have some more time. And on your hedging play with this put that we're going to enter, you're just anticipating a move down. So you're like, let me make some money on this move down. I'm going to lose a little bit of profit, on my long-term play than I am on the upside, but I still have an overall consensus that Apple is going to move up. See, we're here. You still believe we're going to go to a higher price, and you still have some time. Like April's not even on this chart. April's all the way over here, and we're here at this point. So you have plenty of time to still allow your April play to move. So let's do the put. Like I said, we have, we're going to do at the money, 135 strike, doing a put. And let's move to the next day. And obviously we can see what the chart did. So here's the 29th, here's the 30th, 31st, the 4th, and we can go until the 6th. So let's just move let's just move the dates a few days to the 6th. So here's the next day. All right, so you lost, let's see, you lost about 1,125 on your call, and you gained 700 on your put. So let's go back. So you lose 1,000, you use pretty much 1,100, and you gain 700. So what's your true loss at that point? Really $400, because you're making money on your put, even though you're taking a little L of lost profits on your call. And again, you're going to stay into your call longer. Let's go to the 31st. All right, so we lost some more money on the call option, and increased by about $250 on the put side. Now we're at the 1st, which is a holiday, so nothing was open. This was the weekend, so nothing changing, and January 4th. So now on January 4th, you are at a $2,475 profit on your put option that expires in February, and on your call option that you're in April, you pretty much lost $6,000 in a few days worth of profit. So now you're no longer over 100%, but hey, that's okay. You're about there. You're still pretty close, almost 90, I believe, with this number here. And let's go ahead and do the calculator. So what do we got? We have 10,775. You divide that by 11, 375. You're at 91%. So you're back at that 91%. I think that was the number in part 2 as well. And let's see what profit you are on your put. 2,475 divided by 7,875. So now you're at a 30% profit on your put, and it's been how many trading days again? We got in here at the end of the day, 1, 2, 3, 3 trading days. 3 trading days, 30% profit. 10% a day, looking good. So now we're back at the mean. We're back at the 20 simple moving average, which it seems to have liked as a bounce area. And so when you're doing a put option and you're going to play that downward movement, yes, you can say, all right, you know, there's going to be some significant, I think there's going to be a significant drawdown from where we just were. And it's going to go all the way to the bottom side of the band. That could potentially happen. Or what's a part of your trading plan is you can just say, I think it's going to go back to at least the mean, at least the average, and which is the 20 simple moving average. And that would be a play from 135 roughly down to 128. That's a $7 move. That's a $7 fall in 3 days. And in those 3 days, again, this is based on the closing price. So when the wick was down here, you definitely had higher than a 30% profit. But again, this is 3 days and you made 30% on your investment. You lost 6,000 in unrealized gains on your call, and you gained 24.75 on your put. So really, you didn't lose 6,000. You only lost an unrealized gain about 4,000 because you have a profit on your put. So let's go to the next day real quickly, and let's see what that number is. You know what? And this is why we want to go to the next day, because here we're at the 20 simple moving average, and we have what looks to be a bounce. So maybe this was that higher low that it was going to start moving its way back up. So let's see what the numbers show for tomorrow. So wow, look at that. You're now down from the, let's look at it again. Go back, go forward. So you lose about $900 of profit on your put, right? 24 to 15.50. But then you gained back about $2,000 on your call. So it's like a win-win, right? It's like a win-win in this situation, because when it does move up, after it's already moved down, you're going to get back some of the gains on your call. But of course, as it moves down, you're going to earn more on your put. And of course, when it moves up, you give a little bit some back. Okay. But here's the thing. You haven't closed this trade out yet, and you still have time. This one, now at today's numbers, right, based off of January 5th, 2021, with today's numbers, you are at a 19% profit in 4 days. So you had 30% profit in 3 days. Now you're at 20% profit in 4 days. Both numbers are still really good for a short-term trade, hedging your already existing position. Man, sometimes I wish I was already thinking these things when money wasn't already in a play. I'm so upset with myself, but it's okay. This is why I like Think Back. This is also why I like Thinkorswim. You can do on demand, or you can go back and say, man, you know what? Make sure I leave some of that capital available so I can do some hedging against my existing plays. Pay attention to when I'm seeing it roll out of the bands. If this is a part of your trading plan, and the Bollinger bands are going to be your indicators, just, pay attention to these things, because these are the way that you can play things. And I know hindsight is 2020. We see this now. Do we automatically see it when we're in it, in the emotions? No, it's harder to see. It really is harder to see from an emotional standpoint. But history does tend to repeat itself. So here we are again. So look, you got the bounce up. Maybe you stayed in and you said, I'll give it another day, see if it still does some pullback, because it can go down a little bit more. And if you waited until January 6th, then of course you were right. And now your put play goes to $4,300 on your put play, and now your call option is down to 8,900. So now in this case, you're down below the 20 simple moving average. You can say to yourself, you know what, it may continue to fall some more, but let's see what your ROI is at this point after 5 days. You got a 55% ROI on your put play, and you've been in for 5 days. Again, this is all based on getting in at the end of the day, or they're based on the end of the day prices. So these things can fluctuate throughout the day. At this point, I would say that it makes sense if you were to set up a trailing stop and maybe would have exited this day when it hit your 50% or 55% ROI. Because also in this case, your target most likely, or could have been, the 20 simple moving average, the mean price. So therefore, you wanted to just go to here and then exit anyways. That's what's a part of your trading plan. And then also when you see the pullback here to the mean, you see an area of resistance, resistance, and resistance. And there's a saying, old resistance can become new support. And it's rang pretty true as well when you look at a bunch of different stocks on uptrends. So now you have this pullback here. You did your put to hedge against your existing positive play. You can say to yourself, wow, take a look at this. I've made 55% on my money in about 5 days. I'm going to take that profit and deposit it in the bank and continue to let my call run, because I do feel that Apple is on still a bullish sentiment, and it's still going to go up and to the right. So let's take this off the table now. You did the put there. You took that profit of $4,300. That's in the bank. That's gone. You're still rocking with your call now. You already did a call from here to here. We did 2 calls, one from here to here, because that was a shorter term expiration. And now we're still in the longer term one. And now let's run it up to where we were pretty much at some good highs at the end of January. So let's just jump all the way to January 22nd. And look at that there, $19,000 in profit on that stock with on that option that expires in April. We're not going to look at what the put would have been, because it definitely would have been at a loss at that point. So don't even worry about that. And you are what? Almost 200% profit. And we're in January. Divided by 11,375. Got 170% ROI. At this point, knowing, we didn't really establish in part 2 what a ROI target was, or even what a price target was at this point. But seeing that you are in so far for about 2 months at this point, we got in here on November 3rd. We're over here at January 25th. So you're in, about 2 months there, 2.5, almost 3. And I was saying we'd probably exit in February. And now we see where it's running on the outside of the bands. So what could we, of course, do again? We can enter into another put because it's ran upside the bands. And this is actually, we're on the 22nd, aren't we? We're on 22nd. Oh, let's go to the next day, which is actually even higher. Your 19,000 turns into the 20, what was it? Oh, it's the 25th. My bad, ladies and gentlemen. You're really at 22,000. Oh, so you're at 20%. And now you see again, we are running up high on the band. We're here on this day. We have 2 more days that it's there, really, but we're here on this day. You're like, oh, there's a doji, there's a new high. It's at the top of the trend lines that I've drawn. It's at the top of the bands. Maybe I should set my trailing stop, or even maybe it's a good time to probably even enter into another put play to hedge my position. And you can do that type of put play there, okay? And you can see that it pulls down to the mean, continues to move up, and then of course we have bond talks and all this stuff that's just dragged it down, dragged the NASDAQ down, tech stocks and things of that nature. So wanted to make this quick short video in regards to that, and seeing, at least doing a put and reading it from the standpoint of a Bollinger Band. This is how you can also create your trading plan based off of, what your indicators are and what you like. When you see this, this is when I will take a potential entry. I'm going to pick an at the money option, or strike, or versus a out of the money or in the money strike, right? You create your plan, what you're able to risk and tolerate. And 2 things that I wanted to mention that I didn't get to mention in the last video. And the reason why we have the RSI here as well is because obviously when we were running up on the top side of the band, I didn't mention this, but look, you can see the RSIs too, giving an indication of some overbought activity there, right? It crosses over the 70, and then even on the day that we enter, it's crossing down below. So it's giving us an idea things are overbought and should be coming down, which it does a sideways thing. And then here we are again with another, in a sense, of overbought signal. And we kind of have one that didn't cross it, but there's one there. And then of course, there's the ones where it's saying, hey, yo, this thing is super overbought back here in September, but this was also split time. And the last thing I didn't mention, and I apologize, is when we talk about standard deviation, and the lower side of the band and the higher side of the band is a standard deviation or an expected move. Again, that's kind of a general aspect of the average true range. And you can add an average true range to your study if you desire to do so. And so average true range, ATR, is what it's generally called. And it's based on 14 days, or that's almost about 3 trading weeks. So if we look at the length let's see here. The waters, simple, average true range. We can base it off of 14 trading days. I believe when you throw it on here, it's a lower, it's going to be on the lower chart. And now we can see like the average true range is saying that and this is a simple one. Let me make sure I got this right. So if this price is 128, we have 118, and then we have 136. Yeah. And then so what's the range at that point? That's 4, that's 3.8. Okay, so essentially I had to talk this out to myself right now. So if the mean here is 128 on this day, right? Then the one standard deviation or one range, one average true range for the past 14 days is down here. If we go all the way down here, this number being about $3.70, $3.60 or so, right? So that means that if we take $3.60 plus times 2, which is about $7.20, so we have 127, and down to the bottom side of the range, you have 118, which is about more like $9. So we have a $9 two standard deviations when this one is, what's the number giving me? 3.7. So it's a little less than $9 on two standard deviations, but honestly, it's close enough. But it's sometimes they're a little different, but this is a good way of estimating it. Another way of determining a standard deviation is based off of the option chain. So we're in the options chain right now, like for today's price of Apple. And over here on the option chain, you'll see the percentage of implied volatility. And then you'll see the number, it's a plus or minus of 3.619. This is based off of like Friday's expiration, or if you were to go down to say June, and we come all the way over to the right, you have a 42% implied volatility. And then what it's saying is the market maker's move or expected move or the standard deviation is $21 plus or minus. So based off of this option expiration, you have a potential of a $21 move up or down from today's price that this stock would be in that would be one standard deviation. So $21 up is $142. $21 down would be $100 on Apple. And it's saying on the June 18, 2021 expiration, that is one standard deviation away, meaning you have most likely an 84% probability that the stock will fall somewhere between those two prices, plus $21.76 or minus $21.76 by the end of that expiration on June 18th. So market makers' expected moves, standard deviations is a whole nother kind of conversation that we can have at a later time, but wanted to just show you guys the put piece. And I mentioned in video number 1 or 2, I think it was, that I'll show you where you can find the expected move or the standard deviation. And that's generally where you can find it, either there on the trade screen, or you can kind of use the average true range as well. Hey, if I'm wrong on the average true range, somebody call me out, make a comment in there, and I'll correct it, or we could go back and forth and discuss that too. Always willing to get better in this process. So of course, wanted to make a short video, but now I think this was longer than expected. But until the next time, you guys continue to think, live, and be unstoppable. I appreciate you. See you until next time. Peace.